What if losing money on paper could actually save you money on taxes? That's the magic of tax loss harvesting. Here's the basic idea. Tax loss harvesting is when you sell investments that have gone down in value on purpose. By doing that, you can use your losses to offset gains and reduce your taxable income and possibly reduce your tax bill. Let's break down how this works in your investment account. In general, in a non-retirement investment account, you only pay taxes on the difference between what you originally pay for an investment and what you sell it for. So if you sell an investment for more than you bought it, you should expect to owe some taxes. And that's not necessarily a bad thing. It usually means your investment made money. But if you have an investment that's down, that's not a total loss either. It might even be helpful in some instances. Let's look at an example. Suppose you need $200,000 for a large purchase. Maybe it's for a home renovation or some other large expense, and you have 3 investments you could sell to pay for it. The first investment was purchased for $100,000 and is now worth $200,000. The second was purchased for $100,000 and is now worth $150,000. And the third was purchased for $100K and is now worth $50K. You have a few options here. The simplest might be to sell your first investment. That's the one worth $200,000 today. Remember though, you still have a taxable gain of $100K, so the amount you'd receive after taxes would likely be less than what you'd need for that large purchase. To keep things simple, let's say you would need to pay a flat tax of 15% on the capital gains. For your $100K of taxable gain, your tax bill would be $15,000. Instead of getting the full $200,000 you'd need, you'd end up with only $185,000. Here's where tax loss harvesting could help. Let's say instead of selling that first investment, you sell the second and third investments. When you sell investment number 2, which is worth $150,000 today, you have $50,000 in gain. When you sell investment 3, which is worth $50K today, you have a loss of $50K. You can use your loss here to offset your gain. Your tax bill from the sale of these 2 investments would be nothing, because a gain of $50K minus a loss of $50K equals $0 of taxable gain. So you get the full $200,000 you'd need for your purchase. This was just one very simplified example to help you understand tax loss harvesting. It can get a lot more complicated when you have different types of accounts and additional factors to take into consideration, but now you have just one more strategy to help you and your family keep more of your hard-earned money.